So I recently got an email from a small business owner. She's 55 years old and interested in a whole life insurance policy that's maximized for cash value, but what she wants to use it for is to pay off some debt she has. She has debt of about $25,000 that she'd like to clear immediately if possible. So her specific question was this: can I front load a policy with $30,000 and then commit to a minimal amount of about $3,000 per year? My response is, yes, you can do that. And you can actually set the policy up where you can commit to a minimum amount of about $2,000 per year, after I ran the numbers and sent them to her. So what we're going to look at is a policy that is front loaded with $30,000 for a 55-year-old female. And then she's got a minimum of $2,000 per year. And then the maximum she could pay if she wants to, is $10,000 per year. Now, in putting this design together, if you're working with a local agent or you're trying to understand the different ways to maximize the cash value, here's something that's important in a situation like that. She wants to start with $30,000 and then commit to a minimal amount. Is that possible? Yes, it does depend on the company, and if the company accepts front loading and such, we're going to look at an example of a guardian policy where she can do exactly this. But here's the thing on this. We're going to look at one product, but two different options. Because when I look at this, when I see an email come through, and then after I have a chance to speak with the individual, I wouldn't do it this way if this is me. And here's why. Funding $30K in the first year, and then just $2,000 per year thereafter, the numbers will look decent, but it's not maximized. Have you ever purchased a product or service? You thought you were getting something really good, and then you find out there is a different product or service available that was better than what you have, and it cost the exact same amount of money, and you're like, oh man, why didn't I know about that? So that's what we want to prevent in a situation like this. So based on her circumstances, if she starts with a lump sum of $30K and then only funds $2,000 per year thereafter, as far as what she's paying into the policy, doing something like this, we're not funding the full 30 up front, but actually making two payments of $15,000 and then $2,000 per year thereafter. That will produce better results, specifically more cash value, an earlier break-even point, where if she wants to use it to pay off debt, that's going to be attractive there. So in a case like this, she asked to see this, $30K up front. So I want to make sure I show it and not just come in and say, well, you know, I would actually do it a different way because I know best. No, I don't like it when I ask for something and someone does that to me, maybe not in that same way, but doesn't show me what I asked for. So what we're going to do is look at exactly what she requested and then the exact same product, but an alternate funding method here. So before we jump into the numbers, a couple of things I want to go through. We mentioned this earlier. She owns a small business. She's got $25,000 in debt that she wants to clear, and how she wants to do this is by pumping money into her policy, then take a loan to clear the debt. This strategy is popular, especially for individuals that have credit card debt or high interest debt, because you'll see that the loan interest rate in the policy in this particular example, with this product, is fixed at 4.76%. So she can lock in a low fixed rate relative to what she has with the high interest debt, potentially credit cards and such. So again, pump money into the policy, then take a loan to clear the debt, and then pay back the policy loan with the debt payments I was making on the credit card debt, other debts that I have. So if I was paying $500 per month, I want to take that $500 per month and repay the policy loan. Now what's important to do here is review the impact of that policy loan when I take it. What's the impact on my cash value? How much can I borrow after I take that loan? What's the impact on my death benefit? How much do I pay in loan interest to the insurance company? And compare that with how much I'm receiving in dividends and interest from the insurance company. So I can see, does this strategy really work in my best interest, or am I just paying an excessive amount of interest to the insurance company? Here's a very, very important piece before we look at the numbers here. So important here, and it's often overlooked or not discussed. The debt piece. How did that happen? is this a case where my spending was out of control and it's still out of control? And if I clear that debt, I wipe out the credit card debt, I take out new debt on my policy loan, which I've got control of paying back, but is the credit card debt just going to resurface when I don't have this $30,000 lump sum anymore because I put it into the policy, and if I take a loan, that loan's outstanding, I can't borrow again until the value is restored. So if I haven't solved the debt problem, meaning it's still happening, I'm still spending at the same frequency, and I haven't eliminated the debt if I've got unnecessary expenses, I want to make sure I resolve that first, or actually sit down and budget and see where the money's going. Now, at the same time, if it was a case where it happened because she owns a small business and she had some expenses come up, or maybe she invested a lot in the early years and now her cash flow's coming in, she's seeing profit, and she says, no, I see the light at the end of the tunnel. I'm not putting the same expenses on my credit cards or anything like that. In fact, I've been able to knock some of my debt down. I just want to use this strategy because I'll be able to clear it faster. Okay, that's different. So we want to make sure we talk about that just to make sure we don't exercise a strategy now that seems like a good idea, but then afterwards we look back and say, hey, if I would have known this information, I may have done things a little bit differently, or I may have recommended something different. So we're going to look at using the policy to pay off the debt. What we'll look at first, though, is this. This is the important piece here because it's step one in maximizing the cash value. If the cash value is maximized, it makes everything oh so much easier. So here we go. Here's the illustrations. Blank screen. I'm kidding. Illustration number one, exactly what she wanted to do, which is what? We've got $30,000 paid into the policy in the first year, and then $2,000 per year thereafter. So year one, she pays in $30,000. There's your cash value right out of the gates, $28,000 and change. The death benefit is at $450,000. Kind of an oddball number. Where we came up with that is that it gives her a MEC limit of $30,000. So that is the minimum death benefit she needs when starting a policy in order to pay in that lump sum of $30,000. Then we've got $2,000 per year. I ran this through age 65. The main reason why I picked age 65 is because we got a rounded number of $50,000 in the policy and then paid nothing thereafter. Now, she doesn't have to fund it until 65. Maybe it's until 60. Maybe she keeps going for a longer period of time. She has flexibility there. She can pay into this policy up until the age of 95. Not too many people we work with do that, but my point is she can keep feeding the policy if she'd like to. Look at what is highlighted in yellow. These are your total payments, and that's your cash value. Your break-even point is between years 7 and 8, which is not optimized. The reason why is because we're funding just the minimum beginning year 2. We've got a lot of term insurance attached to this policy as well. She's starting at age 55. Not that that's old, but it's older when starting a policy where if I'm only adding a lump sum in the first year, it's not ideal. And going back to that piece we mentioned earlier, if this is me, I would not do it this way. I would make a tweak here. So we're going to look at the tweak. Before we do that, however, what was the maximum she might pay in? $10K. What happens if she does that? Well, it solves that problem of the delayed break-even point. So if, this is a big if she feels she's going to be able to pay more than just the minimum after the lump sum, $10K per year, for example, this option I would be comfortable with. And I would do it myself. But that's if I can pay just more than just the minimum. And I'm confident. If you own a business, you know that expenses pop up that you did not anticipate. You think you're going to be able to do plan A, and you end up doing plan F or something like that. Way off because all of these expenses and stress came out of nowhere, and you spent a lot more time trying to just keep the lights on, let alone make a profit. But my point is, if this is not realistic, and this is, I wouldn't do this option. Here's what I would do to get the best of both worlds. Let's look at the minimum first. So here we go. $15,000 years 1 and 2. So same out of pocket. Look at this. Annual funding, $15,000 year 1. What's your cash value? $13,000 and change. Year 2, you've paid in $15,000. Cash value, $28,000 and change. So your total payments through year 2 is 30. You're at 28 and change. Up here, in year 1, you paid in 30. Your cash value is 28 and change. Very similar. Death benefit. Less in this one. I'm paying in less. Therefore, I need less life insurance for the desired MEC limit. $15K. What's the minimum amount of life insurance I need in order to be able to pay in the maximum funding, which is $15,000 in this example. Then we've got $2K per year, and I funded it for an extra year here because I wanted to get a total of $50,000 in. So we can scrap this one for now. Pretend you don't see this one in the middle. What do you notice when you look at the difference in value? Year 12, you're about $1,000 or $1,200 more in cash value with this option. $1,200 more where your total funding was $50K. How about your break even? Oh, look at that. Big difference there, which I like, and a lot of people like that too. The feeling of having less money in cash value than what you've paid into the product for several years, 7 or 8 years, that's a tough pill to swallow. Like if we're putting our money into a product, a life insurance product, and we want more than just the life insurance, the cash value is a point of interest to us, and we express that we want to maximize it, well, we should maximize it then. And again, this is just the minimum, but if we can improve a scenario where we fund just the minimum, get an earlier break-even point, see stronger cash value performance, why would we not do it? Like, I would do it personally. So here we go. Now let's look at the same thing, but the maximum funding. So here, 15 years 1 and 2, and then $10K per year thereafter. So let's do this real quick, just because this, in my opinion, can be a little bit difficult to follow. Why don't we do it this way? Let's go 30K with the max, 15K with the max, and the same thing, but with the minimums. Now I can see them side by side. And why don't we do this? Let's go cash value difference. Okay, equals this minus this, maximum on the left. So again, if you can fund the 10K, which one makes more sense? The 30K lump sum option. So this column we just created is showing you how much more or less you have in cash value with the option where you fund 15,000 years 1 and 2 directly compared to the 30K up front. So with a max funded illustration, that's the route I would go. However, if you feel that 10K might be a stretch, or if you feel comfortable with just the minimum and in your mind everything above that is a bonus, that's where I would gravitate back toward this option, which is 15 years 1 and 2. And what we don't have up here is the guarantees, but this will look much more favorable based on the guarantees. But you do have more value, you've got more cash value up front, an earlier break-even point. At the end of the day, it is up to her. But this is one of those things, and just looking at it, where it causes pause for the agent. So if I'm the agent or any agent you're working with, where we should look at it and say, okay, 7 or 8 years to get your money back, that is a long time. Can that be improved? Would I want it improved if this was me? And then show that option. We've got 4 illustrations up here, but what it is just one product with 2 different designs. I would start with the option that she feels is most realistic. If it's the 2K per year, the minimum thereafter, this is exactly what I would do. Show these two side by side. And then if you add more, doesn't make much difference. This one might even look a little bit better. But then you can pick which option you'd like to do. Do you want to start with everything up front or spread it out? So let's wrap up now with the debt strategy. This will be fun. So what we're going to do is clear this debt of $25,000. So we've got a $25,000 debt payment. We'll call it credit card debt in this particular example. And we'll assume the monthly debt payment is $500, which when we use our fancy calculator, it'll be $6,000 per year. So from a cash flow perspective here, just to be very, very transparent or thorough, what are we doing? Aside from the lump sum, we have $2,000 a year. Let me put that in a different color. We've got $2,000 a year toward the funding, and then we've got $6,000 a year toward the debt, specifically the policy loan now, because we're transferring this $25,000 debt from credit cards to the policy loan. So the cash flow is $8,000. If she says, you know, I was just doing $6,000 before, I wasn't funding a policy $2,000, so realistically, Steve, this should be $4,000 toward the debt payment, toward the policy loan, then we want to factor that in. That's very important to do. So we'll look at exactly how to do that right now. Here we go. So what we'll look at is the loan workbook, or I should say the illustration where we had 15 years, 1 and 2, and then $2,000 per year thereafter. Because this was the most efficient option, assuming she pays the minimum each year. Let's make this a couple clicks bigger. Very nice. All right, so before I just dive into that, here's what we've got. Illustration, annual outlay, total payments, total funding is a better word, cash value, death benefit, LTV at 95% of cash value. This will show you 95% of whatever your cash value is, minus any outstanding loans. Annual loans. This is the column that you actually punch the number in. What you want to make sure of is that the annual loans you are taking never exceed the 95% LTV. Loan repayment. When you want to model loan repayments, you punch the number in here. We're going to do this in a second. The interest rate, this is with a Guardian product that is fixed at 4.76%, assuming she pays it annually. If she does not pay the loan interest annually, the interest rate will come out to a fixed rate of 5%. Then the loan balance, and then here's the part I like a lot. Yearly cash value growth. This will show how much her policy is growing by in dollar amounts year over year. Annual interest payment, how much she's paying in interest year over year. Comparing these two columns are very valuable. A lot of people tend to like this, including myself. You ever have a mortgage and you hear the first several years you're paying nothing but interest or a small amount's going toward principal, and then over time, here's how much you paid the bank in interest? Have you ever seen that for your mortgage? Some people have, but most people don't, because the paperwork we get is typically in piecemeal and is this huge, thick document. It's like, all right, I can't find this. So having it side by side, I know I appreciate that, so that's why we did this. It helps. Then we've got the total gain on cash value and also the total interest paid over time. And then death benefit with loan. So when we take a loan in this scenario, look at column F and column W, because anytime we take a policy loan, the death benefit will be reduced dollar for dollar. So here we go. The two $15,000 payments. Here's our cash value. In this example, year 2, which could be at the 12-month mark, because she makes her second payment in 12 months, meaning she starts the policy today, 12 months later, the second payment comes due. If we backdate, it could be sooner. But I've got $26,000 in cash value. My debt was what? $25,000. Okay, so here's what we've got to look at. Right now, we're assuming interest only is paid. She's going to attack this loan more aggressively. But if my loan payments are going to be $500 per month, which this calculator does everything on an annual basis, so that is $6,000 per year, would I just plug $6,000 in here? Not if I want to account for the annual interest, because with a life insurance policy, the insurance company is going to bill you for any interest at the end of each policy year. So if it's about $1,200 here, and I'm going to start repaying the loan, could be the same year, if I want to start doing this immediately, or we could defer it for a year and start it the next year. Why don't we do that, just to be conservative? Actually, I'll show you both. I know we have different preferences there. So if I'm paying $1,200, I'm rounding here, I'd want to plug in $4,800 in the loan payment this year. Let's plug in $5,000 in the loan principal payment. I know it's initially a little bit higher than $6,000, but I just want $5,000 per year in loan principal payments, and the annual interest is going to come down. We can do it however we'd like, but this will make it easier. So if I start payments in the first year, here we go. So I took the $25,000 loan, cleared the debt. Here's my loan principal payments. I'm also paying loan interest. Why the loan interest went down in the first year is because we're assuming we chipped away at the principal balance. Let's do this because I think this is a little bit cleaner. All right. So $25,000 loan, interest only payments the year we take the loan. Next year, we begin to chip away at the principal $5,000 per year, and this is a fixed loan interest rate. When you take that $25,000 loan, what happened to your death benefit? What is $265 minus $25? $240,000. This is just a loan workbook we put together. It is not displaying an actual illustration with a loan. You'll see very, very similar results with actual illustrations. When working with an agent, what you do want to do is request these illustrations. They should be shown to you. For example, for modeling loans, or if someone has a loan outstanding on their policy, we definitely want to make sure we show that. This way we can see the numbers and not just hear about what it might look like. This is a workbook that just gives us a quick overview of what things might look like. But here we are paying it back. As you pay it back, you're going to pay less interest. But each year here, like look what happens in year 2. Your cash value growth that year is $135 and the interest you paid is $1,200. So isolating just the growth and the interest payment, we're in the red. Now one could argue, well, based on my debt payments, I'm not anymore because I was paying a lot more in interest before. That's why we look at the whole picture. But then, as we start to chip away at the loan principal, what happens? We get closer and closer. And in this example, it's by policy year 5, where the gains are exceeding the interest paid. Keep in mind, you're chipping away at the principal here. Here we go, getting better and better. Nice. Cleared it all together by year 7. We're still funding it at $2,000 per year. We might elect to stop there. We've got the gains, but let's look at these 2 columns. Now you can see the total cash value gain compared to the total interest paid. When are you ahead? At age 63 in this particular example. Main purpose of this is to provide numbers on this strategy. What does the growth look like compared to the interest paid? So I hope you enjoyed this video. I did, mainly because it was based on someone's actual situation. They have a clear idea of what they want to do as far as how they want to fund the policy, what they want to use it for. But this is a case we see very, very frequently. The numbers might be different. Maybe I want to use the policy for something other than debt. Maybe it's real estate or my business to grow my assets and such. But the thing that pops up, which is the most important thing, is seeing the actual cost to borrow and comparing that with the growth, so the loan strategy, but this, looking at the different funding options so we don't get a product and find out there is something shinier after the fact that we were never shown. Like, that's the big thing right there. Let us know if you did enjoy this video, and if you have any questions at all, please leave them in the comments below. And as always, I hope this helps. Thanks so much for watching. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.